Philip Tyson, Head of Strategy for Futures and Options at MF Global, joins us now from the company's London offices. So then let me start by getting your thoughts on the level that we were speaking there about Greece breaching that 25% level. What do you read into that? Is that worrying from your point of view?
I think it is. I think it is worrying, yes. And I think it's a sign that these pressures on these peripheral markets are going to intensify, I think, over the next few months. The problem that Greece has is that growth was very disappointing. If you look at second quarter growth in Greece, it fell over 7%, and the growth forecasts in Greece, the official growth forecasts, are still optimistic. In fact, I think officially they're looking for a return to small positive growth next year, and I think it's going to stay well in negative territory. In that case, they can't possibly hope to get their debt to GDP ratios down. I mean, that level of debt to GDP is looking like it's going to be 150, 160%. If growth disappoints, it means more fiscal austerity, and in turn that dampens growth, and you go around in this vicious circle. This ad hoc approach that policymakers have of loading fiscal austerity on the peripheral economies just doesn't seem to be working, and in that scenario default risks are going to remain quite high.
And as those risks remain high and that vicious circle intensifies, 10-year breaching 25%, then comes a question about the impact on other Eurozone countries, and as the bond auction showed, we're seeing rising borrowing costs for Italy now.
Yeah, exactly. I mean, the Italian auction today wasn't too bad in the sort of context that we're seeing in the peripheral uncertainty. They got close to the maximum away. The cover was less than last time, but I think they were supported by a lot of coupon and redemption payments. I think about 16 billion or so, plus the fact it was a cheap bond in a cheap part of the curve. So it was a little bit of a struggle. They'll be relieved to have got it away, but I think going forward, it does suggest that it's very important that the ECB is ready there to step in to try and cap any upside to Italian yields.
And is that what will need to happen going forward? Because I know that this bond auction went relatively well, but nevertheless we have seen those borrowing costs starting to creep up.
I think it's very important. The ECB, however reluctantly, will need to be there on the sidelines to step in until the bailout fund, the newly enhanced bailout fund, the EFSF, is fully up and running. But the sort of changes to that are going through the national parliaments are going to take time. That's going to take it to end of October, possibly beginning of November, and that means the ECB is going to be faced with a situation where it's going to be having to step in and intervene and buy these bonds on a weekly basis, to sort of cap the yields. It might even have to step up what it's been doing. I think there was about sort of 14 billion or so in the last week. It might have to step that up in the coming weeks if these default risks and concerns intensify.
So if these concerns do intensify, then, Philip, what does that mean for the banks? Because we have seen French banks coming under renewed pressure, and with reports of a potential credit downgrade, concerns about liquidity and falling share prices, it doesn't look like that pressure is going to abate anytime soon.
No, it doesn't. I think the pressure on the banks is going to increase going forward, and these default concerns is just something that's not going to go away at all. It's going to linger, and it's going to sort of cast a shadow over these markets. I mean, the fundamental problem as well is that even if the EFSF, once it sort of takes over the role from the ECB and it can indulge in bond buying, it's simply not big enough to take account of Italy and Spain. And what's required is at least a sort of doubling or possibly trebling in size to give the markets confidence that if the crisis does sort of gather momentum, it can sort of take care of Italy and Spain. And at the moment, with all the squabbles you're getting in Europe, that just seems like an impossibly large step for the European authorities to take.
Thanks very much indeed for your time. Philip Tyson, Head of Strategy for Futures and Options at MF Global. Good to talk to you.